Hey, welcome back. It's Jason Walter here. In today's housing market update, I'm going to share news regarding mortgage loan forbearances, mortgage applications, as well as mortgage delinquencies. So stay tuned. And of course, please subscribe if you haven't done so already, and also hit the like button if you appreciate real estate market updates just like this one. Okay, let me share my screen with you right now. We're going to dive right into this. So first of all, we're going to go over mortgage loan forbearances because according to the Mortgage Bankers Association, or the MBA, those actually dropped recently 16 basis points from 5.83% to 5.67% as of November 1st, 2020. Again, these are mortgage loan forbearances. So according to the MBA, about 2.8 million homeowners are currently in forbearance. This number has been decreasing. About 5 months ago, this number was about 7 million. So this is a good sign to see. And the share of Fannie Mae and Freddie Mac loans in forbearance actually dropped for the 22nd week in a row to 3.49%. And that's a 17 basis point improvement. So Ginnie Mae loans, which are FHA and VA loans, for example, which require a lower down payment, Ginnie Mae loans in forbearance decreased 18 percentage points down to 7.95%. However, as you can see here, Fannie Mae and Freddie Mac, the percentage is about half of what Ginnie Mae loans are. So it appears that people who have a VA or FHA loan seem to be more affected by this pandemic because of the higher percentage of people who are currently in forbearance. And it says the data this week aligned well with the positive news from October's job report. That was just released just a few days ago, and they had a gain of more than 900,000 jobs. And also the unemployment rate in the US actually dropped 1 percentage point. So we're down to 7.9% is our unemployment, which it was 14% early on during this pandemic. They had a good quote here though. It says that, however, the data continue to show that servicers are still having difficulties reaching borrowers who have reached the 6-month point for their forbearance period. If you recall, you can do a mortgage loan forbearance if you have a financial hardship due to COVID-19, and you can do a 6-month forbearance and then get another 6-month extension. So they're having a hard time reaching people who have reached that 6-month point. So it says servicers are required to get borrowers' consent to extend the forbearance beyond 6 months to do another forbearance period of another 6 months. It says homeowners who continue to be impacted by hardships related to this pandemic should contact their servicer. You definitely should do that. They have some really interesting information here for you. So it says by stage, 22.25% of total loans in forbearance are in the initial plan stage, while 76% are in the forbearance extension. So about 76% of people who have been into a mortgage loan forbearance have opted to do the 6-month extension. So a high percentage are doing a 12-month forbearance period. And it says the remaining 1.76% are forbearance reentries, meaning that someone entered into a mortgage loan forbearance, stopped it, and then re-entered again. But here's a really important part of this video, which I found the most interesting. So here's your big takeaway here, because I haven't seen numbers like this and ever since this pandemic begun. So it's really great to see what people are doing when they exit their mortgage loan forbearance. So it says of the cumulative forbearance exits for the period from June 1st through November 1st, 2020, 31.6% represented borrowers who continued to make their monthly payments during their forbearance period, or in 23.6% resulted in a loan deferral or a partial claim. If you're not familiar with a payment deferral, it basically takes your missed payments that you missed during your mortgage loan forbearance and just gets added to the back end of your mortgage. And that's due and payable at the maturity of your loan or when you sell, refinance, or pay off your loan. It doesn't change any other terms of your mortgage. It just basically adds it into the back end of your loan, which is a great option for homeowners who are experiencing a financial hardship due to COVID-19. All right, 16.9% resulted in reinstatements in which past due payments are paid back when exiting forbearance. I'm actually really surprised that 17% of those who have exited their mortgage loan forbearance opted to just pay off all their missed payments at once. That's one balloon payment. Because on Fannie Mae and Freddie Mac's website, also FHA and VA's website, the reinstatement means you pay the total forbearance amount all at once, all your missed payments all at once. But it does say on their website, you do not have to take this option unless you are financially able to make such a payment. So I'm really surprised by how high this number is. I'd be really curious to know, out of this 16.9% who have opted to do a reinstatement or opted to pay off all their missed payments in one payment. I wonder how many of these had a federally backed mortgage, because if you do have a federally backed mortgage, you do not have to do a reinstatement. So really interesting to see that. However, what's really important here to note, they say that 12% represent borrowers who did not make all of their monthly payments and exited forbearance without a loss mitigation plan in place yet. So people have opted to just exit their mortgage loan forbearance and have not contacted their servicer about how to pay that money back. So you do have to pay the money back, but there's a bunch of options, especially if you have a federally backed mortgage. You can do a reinstatement, which is paying all your money back, all the missed payments all at once, but they say you do not have to do that. Or you can do a repayment plan where you bring your mortgage current over a set period of time, potentially up to 12 months. You can do a payment deferral, or you can do a loan modification. So there's a lot of options for people who have a federally backed mortgage. So I'm really curious, out of these 12%, how many of those have a federally backed mortgage? If you have a federally backed mortgage, you should definitely contact your mortgage loan servicer, the company you pay your mortgage to, because you have options available for you. You don't have to make a lump sum payment if you have a federally backed mortgage. In any case, 7.2% resulted in loans paid off either through a refinance or selling their house. And then 6.8% resulted in a loan modification. A loan modification just changes the terms of the original loan. Often it results in a lower monthly payment. Then also it says that the remaining 1.9% resulted in repayment plans, short sales, deed in lieu, or other reasons. The deed in lieu, that's a deed in lieu of foreclosure, which basically means you transfer the ownership to your lender instead of doing a foreclosure. It saves a lot of time and money to do the foreclosure. So a deed in lieu is basically just transferring ownership to your lender. So that's what that is. Let's go over mortgage delinquencies, because those actually decreased in the third quarter of 2020. And by the way, if you have any questions about mortgage loan forbearances, I have done a lot of research about it, so please let me comment below if you have any questions about it. And I'm probably talking too quickly anyways. The delinquency rate for mortgage loans on 1 to 4 unit residential properties actually decreased to a seasonally adjusted rate of 7.65%. This is according to the Mortgage Bankers Association again, and this is for the third quarter 2020. However, it's really important to note here, this is a survey they did, and the MBA is including those who are in a mortgage loan forbearance. They are reporting those as delinquent. So for the purpose of the survey, anyone who is in forbearance is considered delinquent. So I want you to make sure you understand that, or make sure you're aware of that, I should say. The delinquency rate was down 57 basis points from the second quarter 2020. So it's great that the delinquency rate has been decreasing, but when you compare it to 1 year ago, it's up 368 basis points. And I imagine because they're including forbearances here, a lot of these people who are delinquent are really just in forbearance. So it says the decrease in the mortgage delinquency rate was driven by a sharp decline in newly 30-day delinquencies and 60-day delinquencies. However, the vast majority of people who've entered into a mortgage loan forbearance entered into the forbearance plans around April to May of this year. So many of those are more seriously delinquent rather than newly delinquent. And that's what they say here, actually. It says the 90-day and over delinquency rate continued to grow and reached its highest level since the second quarter of 2010. However, I don't believe in 2010 we had the government saying, hey, if you have a federally backed mortgage, I don't believe you even had the option of doing a mortgage loan forbearance. I've been a real estate agent for 8 years now. I've actually never even heard of a mortgage loan forbearance until this year. So comment below if I'm wrong on that. It says with forbearance plans still active and foreclosure moratoriums in place until at least the end of the year. Yes, there is a foreclosure and eviction moratorium until December 31st, 2020. It says many borrowers experiencing long-term distress will remain in this delinquency category until a loss mitigation resolution is available. Again, lots of options, especially if you have a federally backed mortgage, if you want to exit your mortgage loan forbearance. So according to the MBA, those with FHA and VA loans continue to be disproportionately impacted by the pandemic-driven crisis, which I discussed earlier in the video, right? It says the FHA seriously delinquent rate, the percentage of loans that are 90 days or more past due in the process of foreclosure, reached a survey high of 10.76%. all-time high. But it makes sense because of mortgage loan forbearances. It says home price gains and homeowner equity accumulation work in favor for distressed borrowers, right? So if you are experiencing a financial hardship and you're a homeowner, at least in most areas, your home value is increasing because we're at record high home prices in California as well as the U.S. as well. So it says by loan type, the total delinquency rate for conventional loans decreased 75 basis points to 5.93% over the previous quarter, and the FHA delinquency rate decreased 6 basis points to 15.59%, and the VA delinquency rate increased by 11 basis points to 8.16% over the previous quarter, and that was the highest level since the first quarter of 2009. Anyways, it says the percentage of loans in the foreclosure process is down 9 basis points from the second quarter of 2020 and 25 basis points lower than 1 year ago. And this is the lowest foreclosure inventory rate since the second quarter of 1982. No big surprises there because we have a foreclosure moratorium, right? Last but not least, it says 5 states with the largest decreases in their overall delinquency rates compared to the second quarter of 2020 were New Jersey, New York, Alaska, Florida, and Nevada. On the other flip side, it says the 5 states with the largest increases in the overall delinquency rate compared to the third quarter of 2019, so 1 year ago, was Nevada, New Jersey, Hawaii, Florida, and New York. All right, last but not least, let's go over mortgage applications because those actually decreased in the most recent MBA survey. So mortgage applications actually decreased 0.5% from 1 week earlier, and this is for the week ending November 6, 2020. So during this time of year, we tend to have a slowing of a real estate market, and that's very, very common. So I'm not surprised by a 0.5% decrease compared to the week prior. And I would expect as we progress into December and January, that sales pending mortgage applications should continue to decrease. That's just what we see normally on a year-to-year basis. So according to the MBA, the refinance index is 67% higher than the same week 1 year ago. No big surprises here because we have record low interest rates, right, of less than 3%. The purchase index, according to the MBA, was 16% higher than the same week 1 year ago. So obviously more people are doing a refinance than a purchase, but we're still seeing levels higher than 1 year ago when you're looking at purchases or refinances. So according to the MBA, they say that purchase market continued its recent slump with the index decreasing for the 6th time in 7 weeks to its lowest level since May 2020. So the purchase market has been declining for mortgage applications for 6 out of the last 7 weeks. Again, this is somewhat normal for our real estate market, but it's definitely something to follow as we progress into next year, right? So it says, however, inaccurate housing supply is putting upward pressure on home prices and is impacting affordability, especially for first-time home buyers and lower income buyers. So obviously, we have very, very low inventory in the U.S. right now. It's 19% less than it was 1 year ago. And in Sacramento, where I'm a real estate agent, it's about 50% less. And that's putting upward pressure on prices because we have a lack of housing inventory. And that is today's housing market update. I hope you enjoyed watching this video. If you did, please hit the like button. I greatly appreciate that. And also subscribe to this channel if you haven't done so already, because I post videos about how this pandemic is affecting our real estate market, and I really enjoy making these videos for you. So I hope you gain a lot of value out of them. Also, you can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day, and I look forward to seeing you on the next video.